I'm going to be talking about unlocking financial inclusion. We mentioned beyond CIBIL there, but we essentially mean beyond any kinds of credit scores. CIBIL is the most popular one, hence the title. And how can we unlock it using everyday trust signals in India? Before we jump into that, I just wanted to quickly introduce myself and what I'm doing here. I am a credit product builder. I spent a couple years in the US working at a company called Credit Karma. Still work there as a senior product manager. I moved to India about 3 months ago. Uh, I am currently exploring India's unique position. So, what I mean by that is there is a lot of momentum we're seeing with what is arguably the world's most ambitious digital finance infrastructure. But at the same time, we also have millions that remain locked out at the moment. So, that is the unique position that I'm trying to explore more. Financial inclusion is a very broad term, it includes access to formal banking services that include insurances, savings, credit. We specifically, for the scope of this discussion, are only going to focus on credit inclusion. And then finally, I'm not an expert. I have about 3 or 4 goals with this presentation. The first is just sharing what I'm learning about how big the problem is, what the impact of the problem is. Secondly, the power of the unique rails that India has built, and then thirdly, the opportunities that I personally see that are emerging. And the final sort of side goal is to spark some valuable conversations and maybe like even inspire some of us in this room to tackle this complex problem. So, jumping into the problem itself, the main problem that we're trying to tackle here is how our credit assessment systems create a fundamental paradox. So, if you see the chicken and egg there, it's essentially if you want to access financial products, you need to have a credit history or a credit score. But in order to build a credit history or a credit score, you need to have financial products. This is something that has impacted each of us in some way, shape, or form when we were young. Uh, Still, many of us are young, but as soon as we started to apply for that first credit card or that education loan, I think all of us ran through the same problem. And this paradox exists across credit bureaus in the world. It is not something that is an India specific problem. All credit bureaus only calculate credit scores based on the data that is reported to those credit bureaus. But what makes it worse in India is most Indians do actually have very responsible financial behavior. I think a lot of us have grown up saving. We recognize the value of money. We have daily signals that actually demonstrate financial responsibility, which is very unlike other Western countries in the US, in Europe, for example. And that is the piece that like makes it worse or exacerbates it for India. So that's the definition of the problem that we're going to try and solve or look in more detail. The impact of the problem is massive. Out of the 1 billion eligible Indians, the eligibility we define here is people that are in the age of 18 to 80. Only about one third can access formal credit as of today. We have around 45 crore plus Indians that are underbanked and unbanked. That is the combined population of US, Canada, Australia, Netherlands. When we say unserved, we mean that they don't have access to any credit product whatsoever. When we say underserved, we mean that they have access to credit products, but they only have less than two credit products and the same type of credit product within their reports. So let's say someone with a credit card, a single credit card for the last 2 years, they fall in the underserved category as well. People that typically get excluded are broadly of two types. MSMEs are one of the favorite ones. And then we have a whole skew of individuals. Within individuals, we have urban poor, which are our informal workers, many of which we see across our cities. That includes gig workers, your maids, and so on. Youth, which is what like a lot of us went through, where we had what we used to call a thin file. Thin file credit report is when the bureaus or the lender does not have enough context about you to actually underwrite you with a lot of confidence. And youth is also another term for it is like new to credit. And then again, rural populations, which is, I think, very much a known problem. uh, why this matters, like the impact of this is that it is not just a social issue, it becomes an economic bottleneck. So for a lot of people, access to credit products or financial access is their means to escaping poverty and also building financial resilience. When we say financial resilience, we essentially mean resilience against unexpected shocks or emergencies. A lot of people might have medical health emergencies which constantly put people into poverty in India just because they are not resilient towards those shocks. Consumption is why largely impacted. Lower access to credit has a direct correlation with lower consumption. Upward mobility for a lot of people, lack of access to credit actually becomes an inhibitor to upward mobility. What we mean by upward mobility? The ability to get an education loan. As soon as you get an education loan, you get an education, you mobilize yourself to another economic strata in the economy. And same with housing. And then finally, business growth is more catered towards the MSMEs that are struggling with the credit gap because it stifles job creation, innovation, and the ability for MSMEs to take more risks. So that is the scale or the impact. It also hinders national progress. It does not just impact individuals and businesses. The MSME credit gap specifically is is a puzzle that multiple stakeholders are coming together to solve, and rightly so. Our current numbers are at like 50 trillion rupees, growing increasingly, and about 80% of MSMEs in India lack access to formal credit. We have around 6.3 or 6.5 crore MSMEs, so 80% of that don't have access to formal credit. If they don't have access to formal credit, naturally they rely on informal credit means. We have a lot of those. That is actually sort of bad mouth the name of lending in India. A lot of predatory lending companies have come up offering instant loans at rates which are um, rates that basically put you into debt traps because of how high interest they are. And on the economy itself, credit exclusion impacts about 1% loss of GDP per year, primarily because of lesser consumption and decreased MSME growth. I'm also happy to take questions in between if we have any, but I'll keep us going. So essentially, we spoke about what the problem is, the credit paradox, how large the problem is, and what the impact of the problem is. Now, I just want to switch gears and shed some light on what it is about India that makes me very optimistic. So, we've taken a lot of good steps in the last 10 years. I tried to combine them into milestones essentially. Uh, 10 years ago, 2014 to 16 is where we set a lot of foundations in place. Um, I'm, I'm sure a lot of you have heard about like the PM Jan Dhan Yojana, which is the scheme that allowed people to open up more banks, which if they did not have a bank account earlier. What this ended up doing is it opened the number that we're currently at is 54 CR. 54 crore people in India opened up this particular account, and who were previously unbanked now have access to a formal bank account. If you want to get to financial well-being and financial resilience, the first step is financial access, which is what like this particular scheme did. It also brought the total proportion of Indians that are banked from 53% in 2014 to 80% right now. The emerging India stack, I think we're all fans of it. Aadhaar, UPI, DigiLocker, that essentially helped set the groundwork for identity verification and easy payments, that which is a prerequisite for scalable finance. And then we also introduced a lot of support for MSMEs through Mudra loans, which are like your collateral free loans that still depend on your official CIBIL scores. So we'll get to that later. 2018 to 2020 is where we started tackling the data infrastructure foundation. We announced the account aggregator framework, essentially consent based data sharing, which is something that's not been done before, at least at this time. Uh, Threads I don't know how many of you are aware of it, but it is another MSME initiative that allows MSMEs to discount or finance their receivables invoices because the credit cycles are too long for MSMEs. So that is again an MSME focused initiative. And then we had the public credit registry that centralized all borrower info in one place. 2021 to 23 is the credit enablement era in my mind. We took really big strides with launching the Oaken framework. We'll dive into that later. And then 2024 and 2025 is where we are currently today, where we're really looking at alternative assessments for at least stratas or member cohorts that we cannot do anything else for unless we do alternative assessment in a way. I'll keep us moving. So the foundational pillar of where we are today is really the India stack. This is the infrastructure that enables everything else. The four sort of tenets here that I see personally is like Aadhaar that really opened up eKYC for us. UPI, which has had multiple good things come out of it. Apart from just peer-to-peer payments, it also acts as like one of the strongest source of data signals about digital financial footprints, and also facilitating like more seamless fund flow between peers, but also between banking and financial institutions and people. Uh, DigiLocker is like the digital document storage system that allowed us to again further streamline the overall verification that a lot of lending institutions require. And then finally, account aggregator is to me like the crucial secret sauce. Consent based financial data sharing. This is something that, because it is missing in other countries, I can give you an example of what we're trying to do at Credit Karma. It's one of our primary objectives is to make sure that people connect their accounts. Once people connect their accounts, we can unlock so much more financial guidance and assistance for them. But because there is no infrastructure in place in the US, that increasingly has become the bottleneck for us, which India sort of preempted and pre-visioned and developed. The second piece of the whole evolution that I wanted to focus on was the Oaken framework. So if like you all have heard of the Oaken framework, how it essentially works is on the image on the right, you see a bunch of different players, right? Up until we had the Oaken framework, the lenders uh, basically made sure that they were the data provider, the collection agent, and so on. And so, in order to lend scalably, they had to do good in each of those sectors or each of those functions. What the Oaken framework is trying to do is it is unbundling the whole lending value chain. It is requiring each person or each entity to become a specialized entity in their work, and then connecting all of them through open APIs. What this ends up doing is it firstly democratizes credit. There is a lower barrier for many apps and businesses to partner with lenders today. It reduces the cost of custom integrations. If let's say I am Zomato today and I need to start offering uh, loan products to my gig workers, I can directly plug into this framework and get access to hundreds of lenders that are part of the Ocean network or Oaken network without actually custom integrating with each of them. And then it has massively increased our reach also, because earlier the strands of the population that we weren't able to reach before, we can now target them as well. And then it unlocks new, more specific credit products, which we will also dive into. So I'll keep us moving. In terms of like a quick recap, we spoke about the problem. We walked through how India has built what is arguably like the world's most ambitious digital infrastructure. Now, I just wanted to jump into the opportunities that I see emerging, which are really spread across three frontiers: reimagining credit assessment, the ability to offer personalized financial products, and then distribute them in a way that is only possible today. So we'll focus on three frontiers that I think are important. Um, if you remember from a few previous slides, we spoke about who are the pieces of population that credit exclusion impacts. We spoke about urban poor, we spoke about rural populations and MSMEs. The frontiers that I've chosen to discuss today are mostly focused on urban poor. The reason for that is alternative assessment is something that we can do today for urban poor. This includes your youth, your thin file people, and your informal workers. And separately, the government is making a lot of steps to tackle the rural population and MSMEs. So that was the reason to focus on urban poor. Uh, the first frontier that I see is having the ability to develop supplemental trust scores. What data we can signal credit worthiness? We have financial transactions that are readily available today. We have bill payments and platform data that we can also plug in. Uh, and then for MSMEs, there's also business data and then digital footprint that we can also look at. uh, this is the bare this in my mind is like the bare minimum for alternative data that we can use to signal credit worthiness. And the opportunity here is to create trust scores of some kind using ML and AI on this consented alternative data. How this can act alongside credit scores is as a supplemental credit score. It can act for youth as an on ramp to the formal credit score or credit history sphere. And how how it makes our lives vastly simple is again account aggregator framework secures financial alternative data, and Oken allows us to do everything with open APIs. Just as an example, there are a bunch of companies across the globe that are trying to do alternative credit assessment. This is not something that we're suggesting for the first time. There's one of the most popular companies is Upstart, for example, in the US. Uh, Things are wildly more difficult for them versus for us, just because we have the infrastructure that is already in place in order to do alternative assessment and hyper specific lending on top of it. They've seen huge gains in terms of how many people can now access credit through alternative scoring. And that's something that we are trying to replicate here, especially given that we have the infrastructure in place. The second frontier, after you are able to do alternative assessment, is very hyper personalized vertical products, which was earlier not possible. Uh, we can now offer credit products for very specific needs that traditional lending has failed to address. So, less than 10% of any retail credit goes to specific purpose loans. I picked two vertical products that made a lot of sense to me. We can jump into as many verticals, look at their alternative data, and create very niche financial credit and lending products that have not been possible before because of the digital public infrastructure and the Open framework. So the first one here is education and upskilling. So these are essentially short-term financial, flexible financing for skills that eventually, again, upward mobilize people. Um, as of today, we see around close to 5 crore people try to upskill yearly. The number might be much higher in terms of the people that actually want to upskill but cannot because of barriers that we have in place. Only 5% of them access formal loans. That includes people that might not need loans altogether. And again, for underwriting, some of the things that you can consider using here is like verified enrollment, platform engagement with like Udemy, Coursera, etc., and employer endorsements altogether to again create those niche lending solutions. On the other side, with healthcare emergency, the idea is really financing for medical emergencies and shock. Um, 60% of the people in India lack health insurance, and more than 6 crore households face medical shocks annually. When we say shock, we mean that they were not resilient enough to completely ruin their financial standing because of that medical shock. And again, we have a lot of data that we can use today in order to underwrite very specific products solely for health emergencies. Example is like digital health records, insurance claim records, pharmacy patents, fitness app engagement, etc. All right. So the last frontier that I personally see is embedded distribution. So historically, financial services or banks essentially have struggled to acquire customers just because there are many pieces in the lending life cycle that they have to many functions that they have to perform, and each piece, like a supply chain, loses some amount of there's some leakage across the whole value chain. Now with the open framework, we are saying that lenders focus only on underwriting. Collections agents are separate. Loan service providers or loan agents are separate. Uh, Dispersal agents are separate. Each of them is specialized, trying to do their own thing. You talk to each other using open APIs. And because we are able to offer credit products through this network, we can start embedding them into a lot of uh, platforms where Indians are already very, very much digitally active. So the unique opportunity obviously is financial products remain disconnected from everyday digital experiences. When we say everyday digital experiences, we mean your Amazon, your Netflix, your Uber, etc. But the digital public infrastructure today allows us to do consent-based financial services at the point of need, rather than you going elsewhere. If we recognize that you have a need for a financial product, we come to where you are. And embedded finance again allows contextual delivery of credit and financial products. And what this essentially does is it reduces or increases the acquisition and distribution efficiency that was largely impossible before digital public infrastructure. So the infrastructure and Open together alter the distribution economics, and they unlock new customer segments that were also not possible to be served by lenders earlier. So essentially, lenders do want to lend more. Borrowers also want access to lending products. But we've always had this credit invisibility layer, despite having very strong everyday signals that show financial responsibility. I think that is the last slide. And yeah, the vision was just an ecosystem where our infrastructure and ethically use alternative data provide fair credit opportunities to millions more, not existing millions, but millions more is like the secret for me and MSMEs. Thank you.